Well, thank you, everyone. And now we will open for a Q&A session. And if you raise your hands, Isiar or Marta will bring you the microphone to you.
Can you hear me?
Yep.
Yep. Okay. So this is Paco Ruiz from Exxon. Thank you for the presentation. I have two questions. The first one is on the growth, because you reiterated this mid-single-digit growth despite growing in electric vehicle well above the industry in most of the cases. Also, you commented that your addressable market will grow 8%, with a market growing only 2 point something. So mid-single-digit means that you're growing in line with your addressable market. So don't you expect to gain market share on your market? And the second question, I make two, and probably I will get back for more. It's on the net debt target. Okay, so you mentioned that you're going to reduce the leverage, but also with the improvement that you expect on EBITDA, that means that practically the absolute level of debt will not decline in these 5 years. So with 300 million euros of free cash flow, where the excess of cash will go? Thank you.
Okay, thanks for your question. So I take the first one around the growth. I think, as you know very well, we have always tried to deliver in terms of growth, and it's true that from our history, we have always guided maybe a little bit more conservative. So it's true that we have a good target, we have a growth ambition. As we mentioned, we have a good positioning. The EV market and our sales to the EV, we feel quite comfortable. But I think we have always, let's say, decided that we don't want to put an additional pressure for us because the market is going to evolve in the next years to come. But to your question, and being quite straight, yes, maybe we are a little bit conservative in our growth targets for the next 5 years.
And in terms of net debt, the way we measured it, which is basically the free cash flow before dividends and any potential M&A transaction, what's going to happen in the next years to come is that obviously we have investment plans which are driving a large part of the cash that we'll be generating as it has done in the past. And in order to be able to meet the growth phase which we are facing in EV, and to meet the expansion that we've said in terms of sales, we will be investing a part of it through free cash flow generation.
Could be.
Could be, but it's not something which we are now foreseeing.
Yeah, thank you. Akshat from JP Morgan. 3 questions from me, please. The first one, coming back to ROCE as a core KPI. You mentioned that you have a target to improve from 14% to 17.5%. And a couple of points that were very important in that is you mentioned strict capex control and you mentioned North America margins. I'm just keen to understand if you can provide more details on that. Do you have an absolute capex range that you're willing to talk about for the next few years that you're willing to spend in terms of organic capex? And even on North America margins, you've talked about double digit. Is it possible to be more specific? And do you have a timeline on North America margins? Are we talking about 12%, 13%, or maybe an ambition to get to 15%? Probably just some more details on that will be helpful. And the second question is on China. You mentioned 12% of your revenues in China today. How much of those revenues are with international OEMs? How much of the revenues are with local Chinese? And how do you expect that to change with the order book going into 2027? What portion of revenues will be in China and how much with the local Chinese? Thank you.
Maybe I can take the one on CapEx, if that's okay. Okay. So in terms of CapEx, we have not provided a specific guidance as we have provided in the past, as you have seen. And that's basically because the shift right now, it's towards profitable growth and towards showing to the market that we are committed to this profitable growth and that we can demonstrate that profitable growth by means of return on capital employed. So we are going to invest, obviously, in growth CapEx, and that investment in growth CapEx is what's going to drive top-line growth, mid-single digit above the market between now and 2027. But therefore, I cannot, or we are not sharing any specific guidance on the CapEx investments going forward.
Yeah, and in terms of our North American operations, it's true that we have guided to be in double digit by or before 2026. We know that now the kind of projects that we have been awarded, we have a very sound profitability, and we have also prepared in full detail all the costs associated with the different launches. In Mexico, all the programs that we are facing and the average profitability of our operations in Mexico are running very well, and we see a lot of opportunities, also quite profitable in this idea of Mexico as a nearshoring. And of course, in the case of EBITDA, as far as we are going to get to products like stream-sized parts, like the door rings, and in the future to battery boxes, we are convinced that very quickly we are going to have our operations in North America with an EBITDA margin in line with the average of the group. That is our target. Of course, right now, the target that we have committed is by 2026 to be in this double digit. But of course, the real focus of the complete organization is to improve much more. And concerning China, right now, it's true that it's 12% of our sales. Today, still, let's say, probably around more than 70% of our sales is to a kind of international players. But in the last 2-3 years, we have increased a lot our cooperation with local players, and also pure EV players, some of them Americans. So in the long run, we see clearly that year after year, Chinese OEMs are gaining land in the domestic market. I remember that just 8 years ago, the share of the Chinese OEMs in China was basically 30%. Now, probably something around 50%. But when we are coming about EVs, the kind of market share gaining by new Chinese OEMs is dramatic. So probably what our real focus right now is to work more and more with local Chinese OEMs, and especially to be very close to the pure EV players.
Thank you, Alexandre Verdi, Kepler Cheuvreux. I have 3 questions, please. So on the EBITDA bridge, which of the building blocks you think has the most contributing to your target? I mean, the other way to put it, if anything goes wrong on the volume side of things, are you still comfortable to reach your target? That's the first question. The second I have is on the pathway to this target, and related to what you mentioned during the IPO, so 15% EBITDA margin. What is needed for you to reach that? I think during the last CMD, you confirmed this target. Is it still the case today? And the last question I have is on management incentivization. So there is this new KPI. So can you confirm that it's part also of your incentives direct, whether it is short-term, long-term? And is it replacing another KPI, or is it coming on top of that? Thank you.
Okay. Maybe you can take. Yeah. So on the EBITDA bridge and volumes, in general, I mean, we've seen substantial volume change over the last years. And what we have managed is to be flexible and to be able to transform our financial profile during those times. And obviously, we do have the expectation that volumes recover in the foreseeable future, in the next 5 years. And at the same time, if that were not to happen, it could have an impact, obviously, on our profitability, but at the same time, we would take other measures in other places in order to be able to try to reach our objective. Talking about the 15% EBITDA margin commitment at the time of the IPO, I think it's fair to say that it's a commitment that was done at the time when volumes were more than 90 million vehicles, when raw materials prices were substantially lower than they are today, and where the cost structure inflation was obviously completely different. Just talking essentially only about raw materials, I think that our EBITDA margin would have been much higher if the raw materials would remain stable. That's why going forward, when we've done this commitment between 150 and 190 basis points, this commitment is based on reported EBITDA. It wouldn't be adjusted for raw materials as we have been doing over the last couple of years. In essence, because we think that going forward, raw material prices are going to remain higher at the levels that they are today. On your last point on the incentive, I guess you're referring to the KPI on return on capital employed, and not because we do have also another incentive based on the ESG plan that Ernesto mentioned. No, in the case of the return on capital employed, it's the metric which the management is going to be measured for the long-term incentive, and it's not replacing any KPI.
Hi, good afternoon. First of all, thank you very much for the tour and your time during these days. It has been a pleasure to be here, and it has also improved a lot our knowledge on the company. So thank you, I appreciate. My first question probably is on EVs. I mean, we have spent a lot of time during these days and a lot of time on the presentation talking about IV prospects, but I see little concretion on the 2027 targets, especially on the margin side. I will expect that with that massive improvement on EV, that will translate something into profitability. And when I see the different levers of the profitability, I see little reference of that massive shift in terms of the mix of the company. Mm-hmm. And my second question will be probably on the CapEx front. It is fair to say that a significant part of the improvement on the return on capital employment is coming from benefiting from extra investment in the past, and therefore you need a more limited contribution going forward, and that explains a little bit of the mathematics of the improvement on the return on capital. And probably my final question might be on the phasing of all these targets. This is something that will be back and loaded, or it will be progressively through all the time frame. Thank you.
Okay. Well, I think referring to your first question around EV, I think we have committed to a kind of aggressive target, which means that we are planning up to 2027 to multiply by 5 our sales related to EVs. It's also true that you ask what is going to be the impact on the increase on profitability. I think we should not forget that we are all aware that we know how the trend is going to be, but there's going to be some delays. We have today here, we are here in a plant that we were supposed to be starting some years ago, but still the product is not well defined, and that's why we have some delay. We are going to have some delays. We are going to have volumes from EVs and ICE which are going to be, let's say, confused. So I think we need to be very careful, because in some moment of time it could be that we have some part of this capital which is probably good employee, but maybe in advance, because there are some delays associated with the launch of the new programs. No? So I think regarding the CapEx, maybe you can talk, Nacho, but it's true that we have had in the last 2-3 years a very important support in terms of our capital utilization, because we had investments done in the past. That is already happening today, but less and less, because we should not forget that now we are coming back to a period of CapEx which is quite relevant. Huh?
Yes, and just to mention, when you were talking about the extra investments, it could be a part of it, but it's not so much related to that. It is On CapEx execution, being able to execute in less time, I think I think Patricia provided an example around being able to do the investments in Poland in less than a year. It's talking about a reuse of assets, being able to reutilize some of them, and therefore being able to have a better depreciation and amortization, or it's being able to basically do more focus on the way we want to expand our lines or use the capacity of our lines. Now, on the phasing of the targets, we have not disclosed that. I mean, I think it's going to be relatively evenly distributed, but at the same time, as Francisco mentioned just a minute ago, I think we need to be cautious about the volumes between electric vehicle and ICE, and how the phasing of ICE goes in the future, because there is regulation, there is incentives to the consumer, there is obviously a lot of brands going into electric vehicle, but that phasing may have certain shifts that could impact essentially the phasing of our objectives.
Just a follow-up on the EVs story. So, given that we are making the first step, no, on this electrification story, and with the information that we have today, and with the target that you have already provided, it is fair to say that on the coming 5 years, you see limited margin expansion coming from this area because of whatever, lack of visibility, ups and downs.
No, I don't think we have said that. No, I think that there's going to be margin expansion because of our product portfolio, because of our positioning with clients, because we are anticipating and we are doing co-development with them, because we're going into more added value products, not specifically to EV, I mean specifically to the positioning of our company. Obviously, with the transition of the market from ICE to EV and our positioning with our clients, we are going to have margin expansion, but that relates to the 3 building blocks which I mentioned in my presentation, which is basically volume driven, and that big part of volume driven, it's electric vehicle driven. There is a part which is operational excellence and raising the bar and being able to basically have a better cost absorption. But the reality is that that volume and that operational excellence applies to both ICE and electric vehicle.
Okay, great.
Hi, good morning. It's Enrique Llagues from Bestinver Securities. I have 4 questions. The first one is regarding capacity optimization. You mentioned that it was one of the priorities in the operational excellence program. So the key question is, how much spare capacity do you have? And if you could give us a breakdown among the different business areas in order to see where this spare capacity comes from. Secondly, you gave aggressive target in terms of return on capital employed. Could you disclose what is the internal rates of return of new projects? Because your new return on capital employed target is well above the internal rate of return of 15% when the IPO. Third, I don't know if you could disclose some breakdown among the new EV players in terms of sales or backlog, in order to know how much do they represent currently. And finally, in terms of M&A, what are your priorities? Is acquisition like scrap in order to improve your sustainability profile, or are minorities, are many minorities remaining that you would like to acquire, or something like that? Thank you very much.
Okay, maybe capacity.
So as you know, like we said before, in order to be able to optimize it, you have to be able to visualize across the world. So in the past, we did this at a very local level. Within a plant, obviously, they have their reuse strategy. They understand how their different assets are saturated, and they manage within. You also have this in different divisions, and they've been managing that since the beginning. But now we are trying to do something different. We're trying to do something that's global. So in order to do that, you need data, because when you ask a plant manager if he has extra capacity, the most likely answer is no, don't take my assets away from me. So now we have some data, and we've used that data to understand in certain areas where we can consolidate our current production into the different assets to be able to extract an asset from an area maybe where it's being underutilized, or where we have our volumes very divided into different assets. So we consolidate, and then we've been able to move some of these existing assets already in a lot of projects around the world. You saw an example today in Ludwigsfelde with the press from Sweden, and you also saw it with the furnace. So we do that since the very beginning, and now we're trying to get a better visibility. And we have to do that in terms of data. That comes first.
And in terms of IRR, I think that the 15% threshold which you referred to, and that was referred at the time of IPO, has evolved over time. Obviously, a 15% IRR applied in any region of the world, any technology, any investment, it doesn't fly completely. So we have a 15% target, certainly, but we look at it on a flexible way depending on what are we investing on, how much are we investing on, with which clients, what volume risks does it entail, what type of technology. So it's not a fixed thing, that 15%.
So refer to the breakdown of sales to pure EVs. It's not easy to provide this data because most of our customers don't like too much that we provide this data. No? It's true that we had quite relevant sales figures for one pure EV American players. And also in most of the other pure EV players, we work basically in China. We have provided, for instance, some data around the growth of the activity of ECHA in China, which I think is quite relevant. And of course, there is going to be always a battle between the traditional OEMs with the new EVs. That today, for instance, some of the non-Chinese OEMs are losing the battle in the EVs in China, but that maybe is not going to be the same in the rest of the world. And coming to the M&A, Nacho can talk about criteria, but I think probably there are two different kinds of M&A. No? There is one which is basically related to specific topics that we want to cover, no matter whether it's geography or other topics. And there could be another kind of M&A acquisition, which is coming from the offer from some of our customers to support them whenever they could have potential problems with suppliers. That was important some years ago. In the previous crisis, we did several acquisitions. We did that in the plant, in the initial of the plant of South Carolina, with Leple. We did that in ECHA. We also bought at that time the operations of ThyssenKrupp Metal Forming. So that kind of things have not happened during this crisis because it's been so far a lot of liquidity. But as you know well, things have changed in the last months with increase of interest rates, and we start to see some kind of problems. But for our rest of our M&A,
yes, I think it's fair to say that we have grown through M&A. I mean, this company would not be at where we are right now if we had not done some acquisitions in the past. So that's obviously something that we will that it's not something that can be overruled in the future. Now, going forward, when we look at M&A, we look at it with a strict hurdle rates. So we look at what is the value a creation in terms of that acquisition towards the company and towards our shareholders, and that's the way we're going to look at it going forward.
Hi, thanks for the presentation. This is Álvaro Lence from Alantra Equities. My first question would be on the competitive advantages in battery boxes. I think it's fairly intuitive to understand your competitive advantages in stamping, given the decades of accreting know-how in manufacturing. But looking at the facility tour that you've provided, it seems quite a different manufacturing process. And since probably the configuration of electric vehicles is going to change, I wanted to know how do you having developed this technology in such a short period of time, what's the advantage that you have here, and that if products evolve in the future, you will not be displaced out of this market. The second question is in North America. It has been a significant performance drag since the IPO. And in the presentation, you've mentioned focus on electric vehicles and growing with the local OEMs as the key levers to improve the situation. Does this imply that the problem is lack of capacity utilization, or that the facilities that you have deployed there are a sunk cost and that you need new investments to make matters better? And this takes me to the third question, which is, if I look at Gestamp on a global level, since the IPO, margins, especially if you look at EBIT margins, have not improved that much. So what's been the reason for this, given that since the IPO to today, now you have much more hot stamping, much more co-development, Industry 4.0, and this does not seem to have translated into better margins. So what is the reason for that? And given those reasons, what are the main things that are going to drive that margin upgrade over the coming 5 years? Thanks.
Okay, good. So maybe Ignacio.
Battery boxes, no? To explain, the market of the battery boxes, as we mentioned, is very fragmented. And depending on when the car is launched, technology is changing. Here you have seen the extruded version, and we actually expand our capacities into GV, is ATEM, where we are doing our own extrusions in order to manufacture robust technologies. But battery boxes will change in the future. The main driver will be the chemistry, and the energy density that chemistry will provide will also have an effect in size and technology used in battery boxes. The general tendency, if we can say, is back to simple and more simpler battery boxes in the future. But every customer, we have to say, is doing different. This is it's big, but generally spoken, we have with our technology toolbox the capability to develop for every customer exactly what they have in their demand. Always looking to reuse these capacities later when there is a technology switch.
Coges la de David, cojo yo la de North America. So I think just to complement what Ignacio has said, I think battery boxes has been a kind of a transversal competition from different experts. I think what we have, and maybe others don't have, is a complete view of the car and the crash model and all the body itself. So I think the kind of idea that we can provide to the customers when they are evolving their solutions around battery boxes, I think are much more valid and solid. In the case of the North American plants, we had right now a footprint that in some extent is much more located for the European companies. We had plants in Tennessee, in Chattanooga, we have plants in Alabama for Mercedes, and we have plants in South Carolina for BMW. In all these cases, we are now replacing and taking the new nominations. In the case of Volkswagen, with the new EV, part of the MEV, or in the case of Daimler, also moving the EVA2, and now we are quoting for the next generation of the SUVs of BMW. So these plants are well seated. We need to focus a little bit more in efficiency rather than in nomination. But now what we have is an opportunity to grow and extend our footprint back up in the north and trying to support these moves from the American companies like General Motors or Ford or even Chrysler inside Stellantis. All of them, they had big vehicles, and now they are moving these vehicles into EVs, and we need to provide them with new plants and new capacities in order to ship. Our plant in West Virginia for hot stamping is absolutely full, not just with traditional work with Europeans, but also with Japanese, including Honda and now Toyota, and also with a quite relevant order also for an American pure EV player. So I think, of course, we are launching new plants, but these plants are going to be absolutely different. And maybe for EBIT,
Nacho? I mean, I think that when you referred in the past to EBIT margins not having improved, you need to take into consideration the exceptional circumstances that we lived over the last few years. and that despite that, we've managed to decrease also substantially our break-even point. We've been able to manage our costs. We've been able to manage basically our EBITDA margin and achieve record EBITDA margin with adjusted for raw materials. And going forward, what's going to improve for EBIT margin? Well, certainly there's going to be a volume increase. That volume increase will translate in further operational leverage. There is going to be an increase also in terms of that operationally raising the bar. There's going to be the NAFTA improvement. And in addition to that, below EBITDA, when you look at EBIT, it's going to be a much more efficient use of our CapEx by doing selective CapEx investments, by doing reutilization, and by monitoring very well the use of our capacity and being able to extract that extra mile out of it.
Thank you.
Yeah.
Yes, hi, thank you. Anthony from Oddo. I just had a question on your growth drivers. So maybe looking at them individually, firstly on the battery box business, could you maybe update us on your market share in that business? You gave some targets previously, so I was just wondering where you sat versus these targets today. Then on the hot stamping, how do you see the penetration of this technology evolving and also your market share within that business? Do you still not expect any loss of business from gigacasting in light of recent comments from more OEMs deciding to adopt that technology? And then lastly, on outsourcing, where do you see this higher outsourcing rate coming from, considering we're seeing also further investments from OEMs themselves in the US and also in Europe, notably to fill up capacity? And then I just had also a little side question on the battery box business. Just wanted to know if you could provide more details on the returns and the return profile of that business, considering what looks to be quite heavier investments and a rapidly changing technology. Thank you.
Okay, thank you for your questions. So many questions. We try to answer quickly. So maybe in terms of battery box, it's not easy to right now define what a part of the market share we have. And we refer to the battery box and not to the battery pack. I would say that today, from the experience we have in different areas, probably we will have a more than 20% market share. But we don't have this kind of market share in China, even though we do have a quite important program there in China. Still, our market share in China is lower for battery boxes. In terms of hot stamping, the penetration of hot stamping is really moving ahead every day. I think we are absolutely leaders in this technology with more than 100 hot stamping, and not just traditional hot stamping, but the kind of hot stamping that you have seen before. In terms of geographies, we see now hot stamping, for instance, growing in areas like in India. It happened also a lot in Brazil. So we see that now the technology of hot stamping, which used to be the expensive one, now could be the cheaper one if we compare with aluminum. And in terms of the outsourcing that you mentioned, what we feel clearly right now is that there are many car makers that they have internal capacities that they need to replace them. And today it's very difficult to do a make or buy study because all the OEMs right now are facing huge investments. And they need to focus where they need to grow, which is electrical vehicle. As you know, they are even investing a lot in producing their own battery cells. So the trend is clear. Whenever we had some kind of discussions around a make or buy, right now, in most of the cases, tend to be that they will prefer to buy rather than to make. So we see that in some old presses that are about to be depreciated and they need to change. We see a lot of difficulties for them to invest in battery boxes, that there is something that they could do in-house due to logistics, and they are outsourcing, and for many other projects. In terms of gigacasting, maybe Ignacio, you can provide a little bit more data.
Yeah, maybe explain the gigacasting and the rear, which is just used with some customer. It will affect for us two rails, but generally spoken, gigacasting is used in a few applications. Hot stamping is used nearly in every car of the world. So there is a difference in application of technology. And today, what we see through our core development activities, as we are, I would say, with nearly every OEM developing the next generation solutions for their cars, is that the decision which material to use is depending on the CO2, on the life cycle analysis that we do. And there, aluminum is not the best one, we have to say it. So they have other reasons to use it. And basically, there will be on the market always different options and technologies, as we present here, the one-piece rear rail as an alternative, and more of these evolutions will come. Also to mention that on steel grades will get a higher strength level in the next years, which allows steel solutions to go even lighter than what we have today, state of the art. I would say in the future, there would be always different technologies. But hot stamping, of course, more cars will have that. It's our vision. Yes.
And just to provide some question to the return profile in terms of battery boxes, it's true that there is a lot of uncertainty. So that's why we have decided not to invest or to enlarge a lot our generic capacities, for instance, of extrusion. We had a small capacity, but we are buying the most of the extrusion. That happened also with other kind of materials, and when we are doing the quotations, all the investment associated with this is depreciated in the life of the program. So it's true that sometimes we had the possibility to reuse part of this robot, but the idea is to be in the conservative side. This definition of battery boxes is going to change a lot, as Ignacio has mentioned, and we need to be in the safe side. So that probably means that whenever we talk about battery boxes, the return or the EBITDA margin could change a lot, depending on what part of the added value we decide to buy from outside and what kind of depreciation rate are we applying to this investment, as far as we believe that this project is not going to be extended.
And just to complement, we are firmly committed to profitable growth, as we've mentioned before. And in that commitment to profitable growth, when we look at battery boxes specific investments, we look at it also in the context of an IRR target, which, as I explained before, looks at that volume volatility, looks at which client are we talking about, looks at technology, looks at the lifetime, and takes into account all of those key parameters in order to look at a profitable investment and a profitable capex.
Okay.
Hi. Thank you very much for your time. José Antonio Suárez from CaixaBank BPI. I have a couple of quick questions, if I may. First of all, Ignacio, you mentioned that all the M&A will be value accretive, but could you give us a little bit more visibility about the range of M&A for the upcoming period, something you could provide to us? And on second place, you have mentioned that from a leverage point of view, net debt to EBITDA will be around 1 to 1.5 times. So this ratio includes inorganic growth via M&A, or it doesn't include it? And if it doesn't include it, what will be, and if it includes, what will be the leverage without the M&A? Thank you for your time.
Maybe I'll tackle the second one, and then I can go to the first one. In terms of net debt 1 to 1.5 times, this does not include any inorganic growth foreseen in our business plan. That's the first point. And in terms of leverage, what will happen is that we are firmly committed to a healthy balance sheet. And in that healthy balance sheet, if we were to do an acquisition, we would look at it in the context of what would be the additional cash flow generation that acquisition will bring, and how much would be the deleverage pattern that we will get through that acquisition. Okay? So, and in terms of the range of M&A, look, it's too early to say. I mean, we were talking, as Francisco mentioned, we were talking about different types of acquisitions, either complementary geographically, complementary technologically, complementary client-wise, complementary, or just by our own clients, which are having issues with potentially some of their suppliers. So I think it's too early to state what could be the range of acquisition that we could be seeing in the next few years.
Hi, it's Robert Jackson from Banco Santander. First question is related to your co-development. It's come up. The word co-development has come up a lot in the presentation. Looking at the battery box, could this be an area where you could strengthen the co-development and go further integration, see further integration in the battery box? that's more of a longer-term question. The shorter-term question would be the issues you have in NAFTA. What are the challenges you have to just improve slightly the margins or recover slightly the margins, say this year?
We start with co-development. Co-development is an activity which starts typically a lot of years in advance and can cover the complete crash analysis of a car. In some extent, when we design the battery box co-development, we have sometimes the freedom to decide whether we're going to one or another concept and how much of the crash safety we want to take into the battery or into the body structure of the car. So that allows us to understand customers much better and to develop with them the best solution. So it is really, for us, it's a right tool to leverage technology into the right products, but also for our customers to find the best way for their needs. And technically, in the battery boxes, we see, let's say, a wide scope of different solutions in co-development, especially because we work with crash models of our customers. So we have the real crash models, and so we're working actually on the right solution.
Yeah, and on NAFTA operations, of course, we are doing a lot of work in operational excellence that maybe Patricia can talk a little bit. But I would say that in the short run, right now, probably the most important difficulties in our US operations are related to labor. The labor market is difficult. It's difficult for us to find good and talented people, and also the turnover of people is quite high. So that's why we are still facing problems. In any case, what I can tell you is that we are gaining ground. We are gaining ground, building up good management teams in some of the plants in the south. And also, last 2-3 years, we had some inflation. We have had some kind of discussions, let's say, with our customers. And now I think we are about to go to a kind of reasonable agreement with all of them. So that means that this improvement in terms of how we are in our human resources area, and also about the kind of prices in order to be able to offset the inflation in the last 2-3 years, I think it's going to give us a lot of opportunity, let's say, starting from end of this year. In any case, we have been awarded very important projects. Some of them are still in the ramp-up phase, projects which are rather profitable. So that's why we feel that just with the ramp-up of the new projects and with this improvement in labor and also in the pricing of our projects, I think we are going to start doing things better in North America as soon as possible.
And we have an operational action plan that's specifically designed for every single plant, and there are certain KPIs in the short term that we're wanting to tackle. One of them is scrap. The other one is related to labor. It's more the overtime costs that we're facing. And of course, in the long term, the levers that we're trying to promote, one of them is our labor strategy. We need to change the way that we're acquiring talent in the US. We need to think about different global ways or global support, different ways in which we can bring people into the US in order to be able to really stabilize a good management team in every single one of our plants. And then we have the issue of Industry 4.0. Once you have Industry 4.0, you have a very detailed understanding of what is going on in every single one of our plants. And that's one of the key levers that we need. First, we need the visibility, and then we monitor both the action plan in the short term with the long-term ideas and improvements that we need to do.
Just a follow-up regarding M&A. Could you be looking at technologies, expanding technology, for example, the battery box? Would you be looking to get a closer value added there with new technologies?
Yeah, let's say, actually we have with our technology toolbox all technologies available in order to design battery box for the market, for local or for normal OEM, as well as for the new EV player. There is actually, I would say, not much or not new technology that is needed in the moment for the battery boxes. So in this sense, we are covered at the moment with these technologies. Yeah.
But just going a little bit in detail, one thing is that Ignacio is using all kinds of technologies, but also usually inside the group, what we need to take a decision whether to incorporate or not our industrial capabilities in one specific technology. So that means that sometimes things are evolving. For instance, today we decided that we did not want to have an extrusion, aluminum extrusion capacity, just a little bit to understand. In the case of the casting, whether it's high pressure or low pressure, we have decided to buy from the market, but there could be that in some moment of time, some of these technologies become more important, and we decide that it's a good opportunity in the long run. So far, we believe that it's better to buy from the market, but if it becomes a kind of a standard, probably we will integrate some of these technologies the same way we are doing some developments in fiber or in other topics. No?
Yeah, correct. And from all available technologies, the design capabilities, validation, simulation, bring that into a virtual and validate the, let's say, cost perspective and performance that we can do for every technology, independent if we buy it, as Paco mentioned, or if we manufacture in-house. So we have the same, all these capacities are at Gestamp in-house.
Sorry, can I just have one? Sorry, can I just have one follow-up? Again,
sure.
When we left the hotel, there was a car with a hydrogen taxi. Can you tell us anything about that? There's no mention, we haven't seen anything about it in the visit. Any messages there? Thank you. Thank you very much.
Yeah, hydrogen is an option in the future for, we believe, maybe more in long-distance cars, if hydrogen is available, another discussion. From engineering perspective for our product, the needs for a hydrogen car are the same on the requirements that we need for electrical cars. Basically the same, except the protection of the tanks, the gas tank itself, which we do not manufacture. But the rest of the architecture will be the same from a hydrogen car than from electrical car.
But just to be clear, we see in all our customers that right now the mainstream of everything that they do is electrical. And even though companies like Toyota and others are keeping and preserving some part of the hydrogen, we see hydrogen more moving to industrial applications, as we know. For instance, in the manufacturing of steel, we will see this green hydrogen, and we will see it probably for all kind of transportation, maybe large trucks or maybe ship and these kind of things. But we don't see right now that this is going to be any trend in the light vehicles manufacturing.
Hi, thanks for allowing me to jump back into the queue. Just a couple of questions. Have you seen any trend of near-shoring since the pandemic and the war in Ukraine, seeing OEMs shortening the supply chains and bringing production of their suppliers closer to home, and whether that is an opportunity to fill up spare capacity, or could that be a threat of leaving some of your installed capacity obsolete or as a sunk cost? And my second question would be on the margin expansion guidance. I've noted that the starting point that you've chosen is the reported EBITDA margin in 2022, which was depressed by the raw materials. So just wanted to understand how this 150 to 190 basis point expansion would change if we see changes in raw materials, whether that would be included in that or not. Thanks.
Yeah. Well, starting with near-shoring, I think we see movements, but it's taking time. In any case, we see clearly that the US is taking some kind of quick steps in order to be able to move some production of specific topics to US or even to Mexico. This kind of decision by a company like Tesla to move their battery plants to US or to start a new plant in north of Mexico, I think is a good example of something that is happening. That is in US regarding Mexico. That could be an opportunity for Spain inside Europe. I think so. And I think we can talk about what could be the use of these next generation funds, not just to be in the defensive move, but maybe to be a little bit more aggressive, taking advantage of what is Spain, what kind of cost of energy we can have, or if we talk about renewable energy, and try to see whether we can allocate here important manufacturing of some relevant topics and not to depend 100% from other regions of the world. No?
And in terms of margin expansion, yes, you're spot on. It was on reported EBITDA. And yes, it is because, as briefly mentioned before, we're going to start reporting as reported, basically without the effect of raw materials, which has been something that has happened over the last couple of years, but it's here probably to stay. The projections which we have made and the margin expansion which we have made are at FX constant basis and on our raw materials price as is of 2023.
Hi, Inigo Recio from GBC. Coming back to the CapEx, my question is reasonable to think that CapEx over sales in the coming years could fall a little bit from 8-9% to the range of 6-7%, for example? Thank you.
I think we touched on that topic a few minutes ago. Going forward, we will invest in order to grow as we have projected in our business plan, so mid-single digit, and we will be committed to profitable growth, and that commitment to profitable growth will mean that we will have a selective CapEx investment profile. Now, whether that profile is based on a 6, 9, 8%, it's a little bit too early to say. We are committed to net debt, we are committed to cash flow, but with the CapEx investment profile will depend a lot on how it evolves, that growth in EV versus ICE, how the plans, the volume plans of the different customers happen in the future, and we're not going to be providing guidance specifically on CapEx going forward, but more rather on the return on capital employed.
And no matter what happened, free cash and good leverage.
Exactly, yes.
Yeah, good morning, and thank you for the presentation, for the planned visit. It's Alberto Spelosin from JB Capital. Sorry to come back to these two topics, but I just need a clarification on both. On EBITDA margin, if we assume raw materials flat, that means that on a comparable basis, you are aiming to a 14.5% EBITDA margin, assuming no raw materials effects in the past 2 years. Also on net debt and free cash flow. So with the revenues and EBITDA guidance you provided, net debt to stay flat for it to be a 1 times EBITDA. If you generate 300 million free cash flow, and assuming you distribute 150 million in dividends, where are the other 150 million euros going if this net debt target is excluding M&A? Do you expect to invest them in new EV projects maybe? And also last question on the sector. We are seeing pent-up demand being fulfilled and supply chains getting better and better. This should pressure OEMs' pricing power at some point, maybe into 2024. How are you seeing this situation, and could this have an impact on you, mainly regarding cost negotiations with your clients? Thank you.
So in terms of EBITDA margin and assuming the raw material costs of 2021, the margin which you're putting, I think it's about right. Probably it's about right. Now, in terms of net debt to free cash flow, I think that, as we've mentioned, depends the phasing of the free cash flow generation, the phasing of our projections has some puts and calls depending on that volume growth and on the transition between electric vehicle and combustion engine. And that's why we think, and based on our business plan, that commitment to 1 to 1.5 times reflects probably on a conservative way what we think is going to happen between now and 2027.
Yeah, and refer to the pent-up demand. It's true that this picture is moving, no? And we had a clear pent-up demand probably all around the world 1 year ago, 1.5 years ago. Since then, it's true that especially the semiconductors problem is not over, but it's not such a big problem. And we have seen already that in some geographical areas the pent-up demand is now about to end. We have seen it in China, of course, not only because of they are intending now to export, but there is a capacity available. And today there is a kind of fight in the market, and there is some pressure in the prices in China. And in the US, the latest figures I've seen is that also the inventories are coming close to the normal levels before 2019. Probably there is still some gap in Europe because the loss in terms of demand in Europe was more than that. And we feel that still today is a kind of pent-up demand. The number of new orders probably is being reduced, and probably we will come back, let's say, to normal market conditions by the end of the year. In any case, what is important is that the power or the pressure that our customers can put on us is, of course, depending not just of what are the needs of these customers, because they always want more. So it's not a matter of whether they are earning or not. It's also related to what kind of need they have in order to launch their new vehicles. And as far as they need to deploy a lot of capital around EVs, and suppliers like us, we are in a very good position to do it. It's not so easy, let's say, not to agree on a quite reasonable basis. So there is no this kind of pressure for us. Is it going to come for some other local suppliers and maybe not so much focus in EVs? But that could happen, but that is happening always in our sector. I think probably the strange thing that we had in the last years is that it was a demand, and the industry was not able to cover this demand. That was an extraordinary issue, which is probably not going to be easy to see again.
Ashton, thank you.
Sebastian from InnoCap. Just question on the US turnaround. 3 years to turn around to double digit seems quite long for a problem that has been already identified. Can you help us to understand the phasing? Do you see kind of fix quick things? Because if the basically mid-long term, the target is to get back to the average of the group, I think the double digits is one phase before the second phase. So that's the first question. And the second one, which by part is linked to this, would it be excluded to reach your target, which seems to be more commitment than target, 1 year before? I know you put 27 to reach a return and the EBITDA margin target, but it seems to me, especially given the potential in the US, you can reach it earlier. Is it something excluded or it's potential? I know your conservative is good, but that's a simple question.
Well, not so simple, but in any case, I give it to you, the second one. Now, about the turnaround of the US plants, it's been, even though we have detected the problems and we know a lot, and as Patricia has mentioned, the most important difficulty we are facing is the labor market. I think sometimes it's a little bit difficult to explain, but whenever you get some program and you have difficulties in order to have the right people, and with the kind of inflation that we have had in the labor market, even if we are improving and improving, we have not been able to have enough turnaround. So we need to have a balance, also including some kind of negotiation of prices for customers. Whenever we are doing now the extension of the programs, now we have a good reason in order to renegotiate all these prices. We need to build on people. If we are not able to build a good talent and a good organization and to move people from other places, it's going to be difficult. And of course, it's also important that the ramp-up of the new projects is coming well. We are putting a lot of pressure in order not to have any problem in any further quotations or any project launch. So now we have a perimeter which still is big, which is difficult, it's isolated, it's being difficult really to do a turnaround. But whenever we have this extension of programs, this renegotiation and stabilization of labor, together with the launching of the new vehicles, I think that's going to happen. And I don't want to give you more details around the phasing, because it could be we have already failed sometimes. I've been a little bit more optimistic sometimes around the North American operations, because I've seen it. I've seen it in the figures, I've seen it in the budget, and we have not done it. This time, the kind of plan that we have and the focus we have, the complete corporate organization is there, and is a very important part of what we want to do until 2027. And whether we are optimistic is
I think that I referred in my presentation that we deliver on what we commit. And basically the commitments that we're putting here between now and 2027, we are firmly committed to them and we're firmly committed to delivering on them. If we can deliver on them earlier, the better. But for sure, we are committed on 2027.
Okay.
Hi, just a follow-up on the NAFTA thing. So, it is fair to say that there has been somehow a lack of controlling in the area, because as you refer, you were mentioning labor issues in the U.S. that I believe that they are not going to improve in the next years. So one of your issues in the area has been controlling, and that you have now tackled it. So that gives you comfort in the sense that things are going to improve going forward.
Well, I think North America story, I think it was difficult to tell. So that's why I have tried to focus a little bit more on what had happened. It's true that for many years, the kind of control that we were doing from corporate to the operations was, let's say, a little bit more in the long run and focusing in the strategy and the approval of all the different projects. But it's also true that whenever you had an internal problem in one area, it was not so easy to detect some years ago. I think the team that was able to grow and to develop our position in North America was a very good team. And it's true that the important mistake came in 2015 when we decided really to be aggressive and to double our market size. That was our commitment. And we had opportunities and we have a good positioning. But this team committed some mistakes and we were late as corporate to react. But that was something that happened in 2016. And it's already a long time. But still many of the programs that we took at that time in 2017 and 2018, we are still suffering from a very bad program management, suffering from a not adequate consideration of some inflation issues, and suffering from other topics. So I think we did quite well in 17 and 18, replacing the management, putting new management in place, attracting talent from all over the world. But the current situation in US for the last 3 years, if the knowledge that I have about how is performing rest of our competitors and rest of the peers, I think everybody is suffering. And we have not been able to complete this turnaround of the operations. Now I think we have a good visibility. It's not just a matter of control. There is much more integration. There is much more data. And I think this time we are going to do it. But I think it's not fair from my side to blame an old team or lack of control. It's been rather difficult from 2020 to 2023, and the mistake we committed, I think, at the corporate level, moving too fast, understanding that we had a solid team, but this solid team was not prepared to be able to cope with all this complexity. That was the mistake, and that's why we need to be sure that whenever we are moving forward, we have a complete knowledge of what is going on. That's why we have rebuilt our organization. We have operational excellence. We have also the office for the new strategic projects. So we want to avoid that we are not going to have this kind of mistakes.
I see. And just another follow-up on the free cash flow. I'm going to try to answer in a different way than any other of my colleagues to see I can come up with something different. So, do you see any reason why your free cash flow conversion over EBITDA in the next years is going to be something different what has happened on the past years? Because embedded on the targets looks like you're expecting a worsening on that conversion. I don't know if it's because wall is more difficult than in the past, that you will need to put more balance sheet on the projects, or so because we are missing 100 million euros somewhere, no? So
couple of things here.
In the good side, no? We are missing.
We're
in the good
missing
side.
on the good side. No, a couple of things here. If you think of margin expansion, if you think of better capital expenditure, obviously the output should be better free cash flow conversion. So we are aiming at a better free cash flow conversion for sure.
I think probably is in part is my fault because, as you know, we always need to be close to customers. We have all this plan in place, but whenever you talk about individual targets, sometimes we like to have a little bit of flexibility in order, for instance, to take a very important large project with one single customer, or maybe to do an M&A. But everything that we have said is correct, but probably we wanted to have an extra margin over there. And I think even if you ask us again, maybe we are not going to give you different answer.
Thank you again very much for joining us here today and for your time. And let's hope we can enjoy some lunch at the back, okay?
Okay, thank you very much.
Thank you.
Thank you.